Warren Buffett, you know the name, right? Even if you don't follow the stock market, you've likely heard whispers of this legendary investor. He's earned nicknames like the Oracle of Omaha and the Sage of Omaha. Why? Because he's considered one of the most successful investors of all time. Born in Omaha, Nebraska, Buffett's journey to riches wasn't paved with a silver spoon. He started small, selling chewing gum and delivering newspapers. But his knack for numbers and business was clear from a young age. Buffett's investment philosophy is simple but powerful value investing. He believes in buying great companies at a fair price and holding on to them for the long haul. Over the decades, his company, Berkshire Hathaway, has become a behemoth, owning pieces of iconic brands like Coca-Cola, Apple, and Geico. His wisdom and down-to-earth approach to money have resonated with people from all walks of life. What exactly is value investing, the strategy that made Buffett a billionaire many times over? It's all about finding those hidden gems in the market companies that are undervalued by the masses. Think of it like going to a flea market and discovering a vintage watch worth a fortune, but priced for pennies. That's what Buffett aims to do with stocks. He digs deep, analyzing a company's financials, its management team, its competitive edge, and its long-term potential. He's in it for the long game, buying when others are fearful and holding on to his investments for years, even decades. Buffett's long-term vision and unwavering belief in his investment philosophy have earned him billions and inspired countless others. Buffett's financial acumen is undeniable, but what truly sets him apart is his character and his commitment to sharing his knowledge. He's known for his folksy wisdom, often delivered with a touch of humor. He's not afraid to share his mistakes, reminding us that even the greatest investors are human. His annual shareholder meetings are legendary, drawing crowds from around the globe eager to hear his insights on investing, business, and life. He's written countless letters to his shareholders offering clear and concise explanations of his investment strategies and economic outlook. His philanthropic endeavors, particularly his pledge to donate the majority of his wealth to the Bill and Melinda Gates Foundation, highlight his commitment to making the world a better place.
Now let's bring in our first financial guru, Dave Ramsey. He's a personal finance expert known for his no-nonsense approach to getting out of debt and building wealth. When it comes to Warren Buffett, Ramsey recognizes his genius. But here's the thing, while Ramsey admires Buffett's success, he doesn't necessarily advocate replicating his every move. You see, Ramsey's primary focus is helping everyday people escape the shackles of debt and achieve financial peace. Buffett, on the other hand, operates in the world of high finance, making billion-dollar bets on companies and industries. One area where Ramsey and Buffett wholeheartedly agree is on the dangers of debt. Both view debt as a dangerous trap that can cripple your financial well-being. Ramsey, with his signature intensity, calls debt dumb and a dream stealer.
His debt snowball method, where you prioritize paying off the smallest debts first to gain momentum, has become a lifeline for millions struggling to break free. Buffett, while operating on a vastly different scale, echoes this sentiment.
I've seen more people fail because of liquor and leverage being borrowed money.
Buffett, with his decades-long investment horizon, embodies this principle. He's famously said, "Our favorite holding period is forever." He's not interested in chasing fads or timing the market perfectly. Instead, he focuses on identifying undervalued companies with strong fundamentals and holding on to them for years, even decades, allowing compounding to work its magic. Another key area of agreement between Ramsey and Buffett is their emphasis on patience and long-term thinking. They both reject the allure of get-rich-quick schemes and market timing, recognizing that true wealth is built over time through discipline and consistency. Ramsey often uses the analogy of the tortoise and the hare to illustrate this point. The hare, representing those seeking quick riches, may start fast, but it's the tortoise, with its slow and steady approach, that ultimately wins the race. Now let's talk about a key difference in how Ramsey and Buffett approach wealth building. Ramsey, while acknowledging the importance of investing, is a strong advocate for entrepreneurship.
I often encourage my listeners to pursue their passions and consider starting their own ventures.
Buffett, while he owns businesses through Berkshire Hathaway, primarily focuses on investing in publicly traded companies.
While I understand the value of entrepreneurship, my expertise and primary focus lie in the world of stock market investing.
This difference in approach highlights the diverse paths to financial success. Now let's shift gears and step into the world of George Soros, a man whose investment strategies are as intriguing as his life story.
Born in Hungary, I survived the Nazi occupation and later escaped communist rule to build a financial empire.
Soros is often called the man who broke the Bank of England after his legendary short sale of the British pound in 1992, which netted him a cool $1 billion profit.
Unlike Buffett's focus on value investing, I subscribe to a more dynamic and some might say unconventional philosophy.
He calls his approach reflexivity, a concept that suggests market prices don't simply reflect reality, but can actually influence the fundamentals they are supposed to represent.
Imagine a stock that's rising in price.
This embrace of market chaos stands in stark contrast to Buffett's more measured approach.
Buffett, as we've discussed, is a long-term investor who seeks out undervalued companies with solid fundamentals.
Soros, on the other hand, sees market volatility as an opportunity.
Instead, I focus on understanding the present dynamics of the market, identifying trends, and positioning myself to profit from them, even if those trends are short-lived.
This difference in philosophy is reflected in their investment timelines.
Buffett is known for holding on to his investments for years, even decades.
This difference in approach often leads to Soros being labeled a speculator, while Buffett is hailed as a value investor.
Despite my willingness to engage in short-term trades, I am a deep thinker who carefully analyzes global events, economic trends, and political landscapes to inform my investment decisions.
Buffett, while renowned for his long-term approach, is not averse to making adjustments to his portfolio when circumstances warrant.
He's known for his sharp wit and his ability to adapt to changing market conditions.
The key takeaway here is that both Soros and Buffett, despite their different approaches, have achieved remarkable success in the financial world. Their stories highlight the diversity of paths to wealth creation and the importance of finding an investment philosophy that aligns with your personality, risk tolerance, and long-term goals. Despite their contrasting investment styles, Soros and Buffett find common ground in their commitment to philanthropy.
Buffett, as we've discussed, has pledged to donate the majority of his fortune to the Bill and Melinda Gates Foundation, focusing on global health, poverty alleviation, and education.
Soros, through his Open Society foundations, has also dedicated a significant portion of his wealth to philanthropic endeavors.
While their philanthropic focuses differ, both men exemplify the power of wealth to effect positive change. They demonstrate that financial success can be a means to a greater end, allowing individuals to use their resources to address societal issues and improve the lives of others.
Their legacies extend beyond their financial achievements, serving as inspirations for future generations to leverage their success for the betterment of humanity. Let's bring in Robert Kiyosaki, the author of the phenomenal bestseller Rich Dad, Poor Dad.
Kiyosaki shakes things up with his bold, often controversial views on money and wealth.
Kiyosaki's perspective is shaped by his unique upbringing. He had two father figures, his biological father, a highly educated man with a secure job, whom he calls his poor dad, and his best friend's father, a businessman with a knack for making money, whom he calls his rich dad.
These two contrasting influences instilled in Kiyosaki a deep understanding of the different mindsets and approaches to money.
Kiyosaki encourages us to look beyond the traditional game and create our own rules. Section 2. Challenging Conventional Wisdom, Redefining Assets and Liabilities. Kiyosaki redefines assets and liabilities.
Traditional advice says assets are things you own. Kiyosaki argues assets put money in your pocket, liabilities take it out.
A house with costs can be a liability.
A profitable business is a true asset.
Focus on cash flow and income streams. Section 3. The Rich Dad, Poor Dad Divide, the Power of Financial Education.
Kiyosaki's Rich Dad, Poor Dad philosophy emphasizes the importance of financial education. He believes that the traditional education system often fails to equip people with the knowledge and skills needed to achieve financial success.
He argues that schools focus too much on teaching students to become employees, rather than entrepreneurs or investors.
He contrasts the financial advice he received from his rich dad, who encouraged him to learn about business, real estate, and investing, with the advice from his poor dad, who emphasized job security and saving money in the bank.
Kiyosaki believes that this difference in financial education played a significant role in shaping their respective financial outcomes.
Kiyosaki encourages individuals to take control of their financial education by reading books, attending seminars, and seeking mentors who have achieved the level of financial freedom they desire. He believes that knowledge is power when it comes to money, and that the more you understand about finance, the better equipped you are to make informed decisions that build wealth.
Real estate versus stocks, a tale of two asset classes.
Kiyosaki and Buffett diverge significantly in their investment strategies. Buffett is a master of the stock market. Kiyosaki advocates for real estate investing.
He sees real estate as a tangible and controllable asset class.
Real estate offers cash flow, appreciation, tax advantages, and leverage.
Buffett prefers the liquidity and diversification of the stock market. A diversified portfolio of stocks is efficient and scalable for long-term wealth.
Understand your risk tolerance, financial goals, and investment timeline.
As we've journeyed through the financial philosophies of Dave Ramsey, George Soros, and Robert Kiyosaki, each offering unique interpretations of Warren Buffett's success, we've encountered a fascinating tapestry of synergies and divergences. While their approaches to wealth building differ, their insights, when woven together, create a nuanced understanding of financial success. Ramsey emphasizes eliminating debt and living below your means, providing a practical roadmap for financial peace. Soros challenges us to embrace uncertainty and understand global events. Kiyosaki redefines wealth, urging financial literacy and independence. Despite their differences, these financial titans converge on several fundamental principles that are essential for building lasting wealth. First and foremost is the importance of financial discipline. Whether you're following Ramsey's debt snowball method, riding the waves of market sentiment with Soros, or building a real estate empire with Kiyosaki, success requires discipline, consistency, and a willingness to delay gratification. Second is the power of long-term thinking. While short-term gains can be tempting, true wealth is built over time through patient investing, consistent saving, and a focus on long-term goals. Whether you're investing in the stock market, real estate, or your own business, a long-term perspective helps to weather market fluctuations, capitalize on compounding, and achieve sustainable financial growth. Third is the significance of financial education. In a world awash in financial information, it's more important than ever to be financially literate, to understand how money works, and to make informed decisions about your financial future. Whether you're seeking knowledge through books, seminars, mentors, or financial advisors, investing in your financial education is an investment in your future prosperity. While these fundamental principles provide a solid foundation, it's important to recognize that there's no one-size-fits-all approach to financial success. The best path for you will depend on your individual circumstances, risk tolerance, financial goals, and investment timeline. If you're just starting out, Ramsey's emphasis on debt elimination and building a solid financial foundation provides a clear and actionable roadmap. If you're comfortable with higher risk and have a longer investment horizon, Soros's strategies for navigating market volatility and capitalizing on global trends might resonate with you. If you're drawn to the tangible nature of real estate and the potential for generating passive income, Kiyosaki's approach to building wealth through property investment could be your path. The key is to find an approach that aligns with your values, your personality, and your vision for the future. Don't be afraid to experiment, to learn from your mistakes, and to adjust your strategies as your circumstances change. Financial success is not a destination, but a journey of continuous learning, adaptation, and growth. The wisdom shared by Ramsey, Soros, and Kiyosaki, reflecting Warren Buffett's success, extends beyond specific strategies. Their insights can transform our relationship with money, empowering us to take control of our financial destinies. By adopting financial discipline, long-term thinking, and continuous learning, we can achieve financial freedom, Financial success is about making informed choices and developing sound habits. Embrace it, nurture it, and watch your financial dreams take flight.